Did you know over 90% of the world's financial records are written in English? Whether you're working in corporate finance, bookkeeping, or auditing, mastering accounting vocabulary is essential for success. In this lesson, you'll learn 20 essential accounting terms, from ledgers to liabilities, with clear definitions, examples, and with each term, you'll get a quiz to test your understanding. Hi, I'm Jer, and this is Learning English Pro, the home of professional English. Student members of my channel should head over to the membership tab to download the PDF guide that comes along with this lesson. It's filled with all the content from today's video, along with additional exercises and reading. If you want to join student membership, click the link in the video description to really boost your professional English know-how. And stay tuned after this lesson for my masterclass in accounting vocabulary. I'm stacking lots of individual lessons into this video. They're all timestamped in the video description so you can navigate to the lesson of your choice. This extended video is great for active learners. Pick the lesson you want, get a pen and paper, find somewhere quiet, and really hone in on the language. If you're a passive listener, put this lesson on in the background and go about your day, kind of like the radio. This is a great way to engage your passive learning skills. Okay, so let's get ready and start our lesson, and we're beginning with some nouns. Remember, we're covering the pronunciation, definition, and I'm going to give you an example to understand the context. Then after each term, there'll be a quick quiz question to check your understanding. Our first term is ledger. Ledger. A ledger is a book or system for recording financial transactions. Let's take a look at our example. All company expenses are recorded in the general ledger. And now it's time for our first question to check your comprehension. Which of these would you not expect to find in a company's ledger? Sales revenue, expenses, employee birthdays, or supplier payments? And the correct answer is C. Employee birthdays would not be found in a company's ledger. Balance sheet. Balance sheet. A balance sheet is a financial statement showing assets, liabilities, and equity. The balance sheet helps businesses understand their financial health. Which of these terms is a synonym for balance sheet? Statement of financial position or bank account? The correct answer is A. Statement of financial position. Our third term is liability. Liability. Liability means a financial obligation or debt. Our example sentence: the company's biggest liability is its outstanding loans. Which of these is an example of a liability? A mortgage, company profits, office furniture, or software? The correct answer is mortgage, which of course is a type of bank loan. Asset. Asset. An asset is anything of value owned by a company or individual. Real estate and cash reserves are common business assets. Our question is, which word is a synonym of asset? Input, customers, employees, or capital? And the correct term is capital. Capital represents financial resources or valuable items owned by a business. Let's move on to revenue. Revenue. Revenue is the total income generated by a business. The company's revenue increased by 15% this quarter. Revenue is sometimes called A. Net income, B. Gross sales, C. Liabilities, or D. Equity. The answer is B. Gross sales. This refers also to the total income before expenses. Next up, we have expense. Expense. This word means the money spent to run a business. Rent and salaries are examples of business expenses. Which of these is an operating expense? Employee salaries, customer payments, outstanding loans, or shareholder dividends? Yes, the correct answer is A, employee salaries. If you're enjoying this business English lesson, you should check out my complete professional English course. It's a massive 12-hour video, and for my student members, it has a massive PDF guide that comes along with it. The link for this video is waiting for you in the video description. Our next word is depreciation. Depreciation. This is a key business English word, and it means the reduction in value of an asset over time. Our example sentences: companies calculate depreciation for tax purposes. Which of these assets is most likely to depreciate over time? A. Copyrights, B. Savings, C. Land, or D. Delivery van? The correct answer is D. Delivery van. Equity. Equity. The definition for equity is the value remaining after liabilities are deducted from assets. Our example sentences: shareholders are interested in the company's equity growth. Let's check out our question. Which term is a synonym of equity? Gross worth, total worth, net worth, or gained worth? Our correct answer is C, net worth. Let's move on to audit. Audit. An audit is a financial inspection to ensure accuracy and compliance. The company undergoes an annual audit to verify its financial statements. Which type of company is most likely to be audited? A. A bakery, B. Clothing store, C. A bank, or D. A local cafe? And yes, the answer is C. A bank. Our next term is an important business English word: invoice. Repeat after me. Invoice. An invoice is a document requesting payment for goods or services. The supplier sent an invoice for the materials delivered. Which word is a synonym for the noun invoice? Bill, email, ledger, or check? Our correct answer is A, bill. Now it's time to have a look at some accounting verbs. And first up, we have reconcile. Reconcile. To reconcile is to match financial records with actual transactions. It's important to reconcile the bank statements every month. Which sentence correctly uses the verb reconcile in a business context? The accountant reconciled the company's bank statements. The manager reconciled the computer before sending the email. The correct answer is A. The accountant reconciled the company's bank statements. Our next verb is deduct. Deduct. Deduct means to subtract expenses from taxable income. You can deduct business expenses to lower your tax bill. Let's take a look at our question. Which word is a synonym for deduct? Multiply, minus, manage, or balance? The correct answer is B, minus. Accrue. Accrue. The verb accrue means to accumulate over time, especially financial obligations. Interest on the loan will accrue if not paid on time. What is the most likely to accrue over time? Supplies, meetings, interest on a loan, or policies? The correct answer is C, interest on a loan. We covered this word earlier as a noun, but it's also a verb. Invoice. As a verb, to invoice means to send a bill for services rendered. The freelancer invoiced the client for the completed project. If a client does not pay an invoice on time, the company might send a refund, report, a business proposal, or a reminder notice. The correct answer is D, a reminder notice. Our next verb is a real accountancy term. Amortize. Amortize. The meaning of amortize is to gradually reduce a debt through payments. Our example sentences: the mortgage is amortized over 30 years. Our question is, which sentence correctly uses the term amortize in a business context? A. She amortized her cash by organizing it into wallets. Or B. The company plans to amortize the cost of new equipment over 5 years. The correct answer is B. And next we have a word we've already seen: audit. Audit. And the verb audit means to inspect financial records for accuracy. Let's use it in a sentence. The company hired an external firm to audit its accounts. Which word is a synonym for audit? Examination, experiment, example, or exalt? The correct answer is A, examination. Let's move on to our final section where we cover some adjectives relating to accounting. Profitable. Profitable. This adjective means to be producing more revenue than expenses. The new product line has been highly profitable. Let's take a look at our question. If a company is said to be profitable, it might be called A, bankrupt, B, failing, C, lucrative, or D, startup. And the correct answer is C, lucrative. Our next adjective is solvent. Solvent. We can use this word to describe when a business is able to meet financial obligations. The company remains solvent despite economic challenges. Which of these best describes a solvent company? It's losing money. It has more assets than liabilities. It relies on bank loans. It has unpaid invoices. And the correct answer is B. It has more assets than liabilities. Our next term is a bit of a mouthful. Tax deductible. Tax deductible. When something is tax deductible, it means it is eligible to be subtracted from taxable income. Charitable donations are tax deductible. Let's take a look at our question. Which business expense is most likely to be tax deductible? Employee salaries, personal shopping, stock, or office supplies? The correct answer is office supplies. Our next term is outstanding. Outstanding. Used generally, outstanding means that something is pretty good. But in the world of accounting, if something is outstanding, it means it is unpaid or due for settlement. Let's take a look at our example. The company still has outstanding invoices from the last quarter. Let's check our comprehension with our question. If a company has outstanding payments, it means it is doing exceptionally well, it has large profits, it has unpaid bills, or it has received extra tax refunds. And yes, the answer is C. It has unpaid bills. Well done, you've just learned 20 business terms related to accounting. With each term, you've learned the pronunciation, definition, context, and checked your understanding. Student members of the channel, don't forget to check out the PDF guide that comes along with this lesson. And if you want to join, the link is in the video description. And don't go anywhere, we're only getting started. Coming right up is my lesson on investment types English vocabulary. If you've enjoyed this lesson, make sure to like, subscribe, and comment. Hello and welcome to Learning English Pro. Today we're delving into the world of investments, where we will break down different types of investments and explore the relevant vocabulary associated with each. So if you're ready, let's jump right in. And let's begin with stock market investments. A stock market, in brief, is a centralized marketplace where stocks are bought and sold by investors. Stocks, also known as equities or shares, represent ownership in a corporation or company. When you own a stock, you essentially own a portion of that company. Companies issue stocks to raise capital for various purposes, such as expanding their operations, investing in new projects, or reducing debt. Dividends are payments made by a corporation to its shareholders out of its profits or retained earnings. These payments are typically distributed regularly, often on a quarterly basis, as a way for the company to share its financial success with its investors. And a portfolio is the collection of stocks and securities owned by an investor. Let's move on to bond investments, which are known for their stability. Here are some relevant terms. Bonds are debt securities. This is where an investor loans money to an entity in exchange for periodic interest payments and the return of the bond's face value at maturity. The coupon rate is the interest rate that a bond pays annually, and the maturity date is the date when a bond's principal is due to be repaid. Now let's take a look at a category that encompasses both stocks and bonds, securities. These are financial instruments representing ownership or financial interests in various entities. They play a crucial role in investment markets, offering a wide range of opportunities for investors. Real estate investments involve properties, where you buy properties in order to generate additional income or capital. The term real estate means land and any property attached to it. A common way to gain income from real estate investments is rental income. This is money earned by leasing or renting out your investment properties. Property management is an important aspect of real estate investment, and it relates to the administration, operation, and oversight of real estate properties on behalf of property owners or investors. It involves a wide range of responsibilities aimed at maintaining and maximizing the value of real estate assets. Let's move on to mutual funds. Mutual funds pool money from various investors to buy a diversified portfolio. Key terms include NAV or net asset value. This is the per share market value of a mutual fund. The expense ratio is the cost of managing a mutual fund expressed as a percentage of assets under management. In relation to investments, diversification means spreading investments across various assets to reduce your risk. Our fifth type of investment is commodities investment. Commodities are tangible goods that can be bought or sold. Here are some terms related to this type of investments. Which goods can we consider commodities? Well, commodities can be raw materials or primary agricultural products that can be bought and sold, such as gold, oil, wheat, art, wine, you name it. There are lots of different types of commodities in that market. An essential term of the commodities investments market is future contracts. These are agreements to buy or sell a commodity at a specified future date and price. And the spot price is the current market price for immediate delivery of a commodity. An investment type which is always a hot topic is cryptocurrency investments. These are digital or virtual currencies that use cryptography for security. Here are some essential terms. Bitcoin was the very first cryptocurrency, and it is the most well known, often referred to as digital gold. A crucial term for understanding cryptocurrency is the blockchain. This is a distributed ledger technology that underlies most cryptocurrencies. And if you have cryptocurrency, you're going to need a wallet. This is a digital tool for storing, sending, and receiving cryptocurrencies. Moving along to private equity investments. Private equity involves investing in privately held companies. And the investment management company that invests in private companies is known as a private equity firm. Venture capital is the funding provided to startup and small businesses in exchange for equity. And if you remember from earlier, an equity equals a share in the company. A leveraged buyout, or an LBO, is the acquisition of a company using significant amount of borrowed funds. Our final investment type is a hedge fund investment. Hedge funds are investment funds that employ various strategies to generate returns. Alpha is a measure of an investment's return relative to its risk. Short selling is the practice of selling borrowed assets with the hope of buying them back at a lower price. Our final term is high frequency trading, or HFT. This is a trading strategy that uses advanced algorithms for rapid buying and selling of assets. Hello and welcome back to Learning English Pro. In this lesson, we're going to take a look at vocabulary and terminology relating to economics. You'll learn 15 fundamental economic terms that will help you grasp the complexities of the financial world. Let's jump straight in. And our first term is supply and demand. These are fundamental forces that dictate the prices of goods and services in a market. Supply refers to the quantity available, while demand represents how much people want it. Prices rise when demand exceeds supply, and prices fall when supply exceeds demand. Let's move on to our next term. Inflation. Inflation is the increase in the general price level of goods and services over time, resulting in the loss of purchasing power for a currency. It's measured by the Consumer Price Index, or the CPI, which we'll get into later. The opposite of inflation is deflation. This is where prices decrease over time. It can lead to reduced consumer spending and economic stagnation. Gross Domestic Product, or GDP, measures the economic performance of a country. It's the total value of all goods and services produced within a nation's borders in a given time period. A related term is GDP per capita. This is the average income of a country's citizens and is calculated by dividing the GDP by the population. It reflects the standard of living in a nation. Let's move on to our next term, fiscal policy. This involves government actions concerning taxation and expenditure to influence the economy. Governments use fiscal policy to stabilize economic growth, control inflation, and reduce unemployment. Another type of policy you may hear about in economics is Monetary policy. This is the management of the money supply and interest rates by a central bank. It plays a crucial role in controlling inflation and maintaining economic stability. A recession is a significant decline in economic activity, often marked by reduced consumer spending, business investments, and high unemployment rates. A budget deficit happens when a government spends more money than it collects in taxes. It's usually funded by borrowing, leading to national debt. A trade balance refers to the difference between a country's exports and imports. A trade surplus happens when a country exports more than it imports, while a trade deficit is the opposite. Let's move on to look at different types of economies. A market economy is where prices are determined by supply and demand, and private individuals and businesses make most of the economic decisions. A mixed economy combines elements of both free market capitalism and government intervention. Governments regulate certain industries and provide essential services. Our next term is opportunity cost. This is the value of the next best alternative that must be forgone when a decision is made to allocate resources to one option instead of another. The Consumer Price Index, or CPI, measures changes in the cost of a basket of goods and services over time. It's used to gauge inflation and cost of living adjustments. Our final term is entrepreneurship. This involves identifying business opportunities, organizing resources, and taking risks to create and operate successful enterprises. Hello and welcome back to Learning English Pro. Today we're diving into the world of stock market investments and expanding your financial vocabulary. So whether you're an aspiring investor or simply curious about stock market, this video is for you. If you're ready, let's get started. Let's cover the basics. Stock markets are essential platforms where investors buy and sell ownership in companies. They help businesses raise capital, provide liquidity for investors, and set stock prices based on supply and demand. These markets offer diverse investment opportunities and act as economic indicators. Examples of stock exchanges include the New York Stock Exchange, the Nasdaq, the London Stock Exchange, and Tokyo Stock Exchange. Another fundamental term of stock market investments is shares, also known as stocks. These are units of ownership in a company. When you own shares of a company's stock, you own a portion of that company, and your ownership entitles you to a share of its profits and a say in certain corporate decisions. If you own shares or stocks in a company, you are known as a shareholder in that company. Dividends are payments made by a company to its shareholders as a reward for owning its stock. These payments come from the company's profits and are typically distributed regularly, providing shareholders with a portion of the company's earnings. Our next term is bull market. A bull market is a period in the financial markets characterized by rising stock prices, optimism amongst investors, and overall confidence in the economy. It's a time when investments tend to perform well, and there is a general belief that the upward trend will continue. The opposite of a bull market is a bear market. It's a period in the financial markets characterized by declining stock prices, pessimism amongst investors, and a lack of confidence in the economy. During a bear market, investments tend to not perform very well, and there is a belief that the downward trend will continue. Let's move on to portfolio. This is a collection of investments, such as stocks, bonds, and other assets, held by an individual or entity to achieve diversification and manage risk in their overall investment strategy. Portfolio diversification involves spreading your investments across different asset classes, such as stocks, bonds, and real estate, to reduce risk, as different types of investments may perform differently under various economic conditions, ultimately helping to achieve a more balanced and stable investment strategy. Stocks analysis is the process of evaluating stocks for investment, often using fundamental and technical analysis. Let's take a look at some of the ways stocks are valued. First up, we have the PE ratio. This is price to earnings ratio. This valuation metric is calculated by dividing a stock's price by its earnings per share. Another analysis metric is market capitalization. When you multiply the stock price by the number of shares, you get the total value of a company's outstanding shares of stock. Next up, we have some trading terminology. Blue chip stocks are stocks of large established companies with a history of stable performance. Day trading is the practice of buying and selling stocks within the same trading day. Let's move on to our next term, which is bid and ask prices. The bid price is the maximum price a buyer is willing to pay for a stock, while the ask price is the minimum price a seller is willing to accept. The difference between them is known as the bid-ask spread. The term volume refers to the total number of shares traded in a specific stock or the entire market within a given time frame. It can indicate the level of interest and liquidity in a stock. A market order is an instruction to buy or sell a stock immediately at the current market price. It guarantees execution, but may not guarantee a specific price. A limit order is an order to buy or sell a stock at a specific price or better. It ensures a specific price, but does not guarantee execution if the market price doesn't reach the limit price. A stop-loss order is a predefined price level at which a stock is automatically sold to limit potential losses. It's a risk management tool used by traders. When it comes to the stock market, there are two different types of investors. A retail investor is an investor who buys and sells stocks for personal portfolios, while institutional investors are usually large organizations like mutual funds or pension funds that invest on behalf of others. Tutor and guide. Today we're diving into the world of mortgages and exploring some essential mortgage terms. Whether you're a first-time home buyer or simply looking to understand the process better, this video is for you. Our first term is the subject of our video, mortgage. A mortgage is a legal agreement between a borrower and a lender, typically a bank, that allows the borrower to obtain funds to purchase a home. The property itself serves as collateral for the loan, and the borrower makes regular payments including principal and interest until the loan is paid off. Next up, we have principal. The principal is the initial amount borrowed in a mortgage. It's the base amount on which interest is calculated. Over time, as you make payments, the principal balance decreases. Moving on to interest rates. This is the cost of borrowing money, expressed as a percentage. It determines how much you'll pay in interest over the life of your mortgage. Interest rates can be fixed or adjustable. A fixed-rate mortgage has a consistent interest rate throughout the life of the loan. It offers stability and predictable monthly payments. On the other hand, an adjustable rate mortgage or a variable rate mortgage has an interest rate that may change periodically. It often starts with a lower rate but can increase over time. The fixed rate period in an adjustable rate mortgage is the initial period during which the interest rate remains fixed before it begins to adjust periodically. Let's move on to down payment. The down payment is the initial amount paid by the home buyer when purchasing a property. It's typically a percentage of the home's purchase price, and a larger down payment often leads to more favorable mortgage terms. Our next term is amortization. It's the process of paying off your mortgage over time through regular payments, which include both principal and interest. Over the life of the loan, the proportion of principal and interest in each payment changes. Let's discuss escrow. An escrow account is set up to hold funds for property taxes and insurance. Part of your monthly mortgage payment goes into this account to ensure these expenses are paid when due. Next up, closing costs. These are fees and expenses associated with finalizing a mortgage and the purchase of a home. Closing costs include charges for services such as appraisal, title search, and legal fees. If you're interested in learning lots more related English vocabulary, check the links on screen and in my video description. On my channel, I have lots of English vocabulary videos relating to banking, finance, investments, real estate, and lots more. Let's get back to our lesson, and our next term is pre-approval. This is a crucial step in the home buying process. It is a preliminary assessment by the lender that determines how much you can borrow. This helps you understand your budget and increases your chances when buying a new home. PMI, or private mortgage insurance, is insurance that lenders require from borrowers who make a down payment of less than 20%. It protects the lender in case the borrower defaults on the loan. Refinance refers to the process of obtaining a new mortgage to replace an existing one. It's often done to secure a better interest rate or to change the terms of the loan. Our next term is equity. Your equity is the portion of your home's value that you own outright. It's the difference between the home's current market value and the outstanding balance on your mortgage. An appraisal is a professional assessment of a property's value. It's often required by lenders to ensure the property's worth is sufficient to cover the loan amount. Foreclosure is a legal process in which a lender takes possession of a property due to the borrower's failure to meet their mortgage obligations. It typically leads to the sale of the property to recover the loan amount. Our next term is closing disclosure. This is a document provided to the borrower at least 3 days before the mortgage closing. It outlines the final terms and costs of the loan, ensuring transparency in the transaction. Title insurance is a policy that protects the homeowner and the lender from financial loss due to disputes or defects in the property's title. It ensures that the property has a clear and marketable title. The mortgage origination fee is a charge imposed by the lender to cover the cost of processing and underwriting the loan. It's typically a percentage of the loan amount. A home equity line of credit is a type of loan that allows homeowners to borrow against the equity in their home. It provides a flexible source of funds that can be drawn upon as needed. English teacher. Today we've got an essential vocabulary lesson on real estate. So if you're ready, let's dive in. Our first term for our real estate vocabulary is property. Property refers to physical assets such as land, buildings, and everything permanently attached to them. These can include residential homes, commercial spaces, and even undeveloped land. Understanding the concept of property is fundamental to navigating the real estate world. A mortgage is a financial arrangement where a lender provides you with the necessary funds to purchase a property and you repay this loan over time with interest. It's a significant part of the home buying process and involves understanding terms like interest rates, down payments, and loan duration. Next up, we have the term landlord or landlady. Landlady really isn't used that much anymore. Landlord is a common term that you can use for both genders. The landlord is the individual or entity who owns the property you are renting or leasing. They are responsible for maintaining the property and ensuring your compliance with the lease agreement. Knowing the rights and responsibilities of both landlords and tenants is crucial for a smooth renting experience. And let's check out this term tenant. As a tenant, you are the renter or occupant of a property owned by a landlord. Tenants pay rent to landlords in exchange for the use of the property. An important term in real estate is lease. A lease is a legally binding contract that outlines the terms and conditions of your tenancy. It specifies the duration of your stay, rent payments, and any rules or regulations you must follow while living in the rented property. Leases can vary in length and complexity, so it's important to thoroughly read and understand the terms before signing. Residential properties are real estate assets designed for living, such as houses, apartments, and condominiums. While commercial property refers to real estate specifically used for business or income-generating purposes. This category includes properties like office buildings, retail spaces, industrial facilities, and warehouses. Let's move on to investment property. These are real estate assets purchased with the intention of generating income or making a profit. These can include rental properties, commercial real estate, or properties bought for future resale. Knowledge of investment property strategies is essential for real estate investors and real estate agents. A real estate agent is a professional who assists individuals in buying or selling property. They have a deep knowledge of the local real estate market, and their expertise is invaluable when navigating the complexities of real estate transactions. An appraisal is a professional assessment of a property's value. It is often conducted when buying or refinancing a property. An appraisal is often carried out by a real estate agent. Let's move along to our next term, foreclosure. Foreclosures happen when a property is repossessed by the lender due to the borrower's failure to make mortgage payments. It is a legal process that can result in the property being sold at auction. Let's move on to the term equity. This is the difference between the current market value of a property and the outstanding balance of the mortgage. It represents the homeowner's ownership stake in the property and can increase over time as the mortgage is paid down and the property's value appreciates. Closing costs are the expenses associated with finalizing a real estate transaction. They include fees for services like title searches, appraisals, and legal services. Buyers and sellers need to be aware of these costs as they can significantly affect the overall cost of a real estate transaction. A title is a legal document that proves ownership of a property. It includes details about the property's history, any liens, and the current owner. Ensuring the title is in order is essential to avoid potential legal disputes when buying or selling real estate. In British English, a title would be called a deed. The down payment is the initial payment made by the buyer when purchasing a property. It's typically expressed as a percentage of the property's purchase price. Once the down payment is paid, the house or property is secured for the buyer. A home inspection is a thorough examination of a property's condition, usually conducted by a licensed inspector. It helps buyers identify any potential issues or needed repairs before finalizing a purchase. A quality home inspection can save buyers from unexpected costs and problems.